what I'm going to do today is just, something very unofficial. I'll just share a few slides, a few graphs, a few diagrams, which I basically personally feel are quite interesting. I've given a lot of talks. I've written articles sometimes for our clients and such, and so I come across a lot of charts and graphs. Some which I've come up with my own self, some I've taken from other sources and such. But these charts really are the ones which I feel tell a big story, or at least a story which I find quite exciting. So I'm very excited to just share with you these charts. And again, it's not financial advice; it's really education, just to show you how sometimes a person like me, a strategist, an economist, the way we think or the way I think of the market and how we interpret things. Okay. All right, let's go to the first one. I'll try and keep it to about 15 minutes or 20 minutes so that we have more time for our Q&A. The plain stock market chart. This is the plain stock market chart. It's just really a long-term chart of the S&P 500. As you can see, the S&P 500 basically, if I may call up my pen, just basically took up from here onwards. I think this chart itself, if you look at it, it's a plain naked chart, we call it. There's no TA on it and anything, but it just gives you an idea of what's the situation currently. We all know about the dot-com bubble. We all know about the global financial crisis, and just look where markets are today. So just look at this, and it gives you a perspective that we are really, this past 10 years has been extraordinary. The markets have never ever, as you can see, this chart goes all the way back to 1944. We have never ever seen a market like this. Full stop. Okay. So the big question is what's causing this? I think we all know it's got to do with quantitative easing. But before we go there, there's this other chart which I find quite intriguing. Fred here. Right. Yeah, this guy named Fred. It's actually the statistical data website for the St. Louis Federal Reserve. Anybody can go there. It's free of charge. I do encourage you to go and play around with the charts and such. And they contain a lot of very good data. So if you call up data like this, you can create your own chart. So let me explain this chart to you in a very simple manner first. Okay. This blue line here is basically household net worth. You can basically take it as a household's balance sheet. And as we all know, balance sheet contains asset and liability. So net worth is basically when assets exceed liabilities, you have positive net worth. And what are your assets? So your assets are basically your stocks, okay, basically your bonds. Do forgive me, my pen isn't very clear. Real estate, okay. Maybe, and so on and so forth. Okay, so these are all your assets. So basically, it shows you in terms of financial assets what you have, or in terms of assets in general, what you have. The red line is basically gross domestic product, which we all know GDP, which is growth. Okay, so the interesting thing about this chart is GDP tells you basically roughly what we call fundamentals. Okay, so I could argue that GDP shows you the fundamentals of the economy, but the net worth tells you the asset side of the economy, or the asset side of households and organizations, what they're holding. So between 1950 to let's say 1990, you can see that basically prices of assets more or less moved in line with GDP if we do what we call a normalization for base year of 1970. Okay, so things moved along. Let's see now if I extend this chart over to the current time. The chart which I showed you earlier basically is this grayish area here. Okay. What we've seen since 1990 is basically a divergence where the net worth side actually moved away from what we call fundamentals. So here is really where you say asset prices have gradually moved away from so-called the economic fundamentals. And I think we kind of feel that when people talk about Wall Street diverging away against Main Street, whereas Main Street is the so-called a fundamental of the economy. Wall Street is the represents the stocks and bonds and such. And we can see that that divergence was quite small during the dot-com crisis, grew during the global financial crisis, and now is very big during the current so-called situation. And you can see the grayish lines here, the areas here, the grayish areas here. These are basically the so-called recessions. So recessions are designed to take away the froth, to take away the excesses of financial markets, to try and bring it back down to reality. So every time you have a recession, you see that blue line trying to get back and to near the red line. So basically, it's kind of like adjustment back to reality. So this chart basically is quite intriguing, because if we look at it, what we are saying basically now is fundamentals, or rather asset prices, have moved really, really far away from fundamentals. And this is what we call in recent years, where people have been using this term, the everything bubble. Okay, the everything bubble. This is where people have said stocks have gone up, bonds have gone up, cryptos have gone up, real estate have gone up, everything's gone up. So there is an argument that really this current retracement, this current reset could be much more painful than what we saw over the past couple of crises. Okay, so I think it's a very interesting chart, and to argue it, or rather to look at it from this perspective. One of my favorite patterns when it comes to technical analysis, and if you go to my Twitter feed, you'll see that recently I posted a tweet to say that one of my favorite books is basically this technical analysis book by Alexander Aldous, Trading for a Living. He brings this up, and it kind of with me, because that book was like 20-30 years ago. So this if you've done TA, you realize that this is a reversal pattern. Some people call it a 1-2-3 bearish. Some people call it a 1-2-3 reversal pattern, and so on and so forth. It's basically there's this particular trend line. Okay, after that the markets hit a all-time high, or at least a high. It breaks the trend line. Number 2 here, it fails to take the former highs, creating a lower high, and then basically it breaks down here, creating a lower low. Okay, it breaks down below the so-called previous bottom there. Okay, so when I look at like the S&P 500 for the dot-com situation, so if I do something like this, okay, so basically you've got number 1, okay, and then after that basically this has created a high, so this basically is so-called number 4. Okay, and then basically the market tries to rally, it breaks down the trend line, tries to rally back, so this is number 2. It actually fails to rally back above the previous high, thus creating a lower high. And if you've done technical analysis, a lower high is one part of the downtrend. Now the creation of a lower low is the other part of a downtrend, and effectively when it breaks below this line here, you've created a lower low. So this is low, this is low, this is high, this is high. Okay, high here. So effectively, and quite beautifully, so to say, it retraces back to the former support, now resistance, and we are going all the way down from here. Okay, so this was really a classic reversal pattern in for the dot-com bubble. Similarly, for the global financial crisis itself, sorry, the trend line is a bit off, but anyway, we saw something similar. 1 here, and then 4 here. Okay, and then we have 2 here, and then we draw a line here. Basically, the break here is the 3. So again, a high, a lower high, a low, a lower low. Oops, sorry, lower low and such. Okay, low here and low here. Okay, so basically, again, we see this reversal pattern taking place, and it's pretty common for long-term major reversal patterns to look something like this. So when we come to basically currently, this is the most current chart. I've kind of like taken a few steps back to make it a little bit bigger. We see 2 kind of very clear patterns. Number 1 is we've got this long-term trend here. Okay, briefly broken here, but if I adjust the charts, you can easily just take into account that. Okay, and we have something called an accelerated trend line. Okay, so this kind of accelerated trend line. And those of you who do technicals, you know accelerated trend lines are trend lines which are very hard to maintain long term because they are an acceleration, they are an exponential move. Typically, when it breaks, it will fall back down to the so-called primary trend line. So this is a secondary trend line. But similarly here, you see again number 1, number 4, number 4. Okay, and then the pattern here, and then I think this number 2, was it number 2 and number 3 here? Okay, and then basically, so this is where we are today. So if you ask me, looking at this, it does look as though this is a reversal, and if I'm applying technical analysis, the viewpoint probably is it probably will move back down to what we call the so-called primary trend line, and this area here lies roughly around 3004. And if you kind of draw a kind of a support region, you find that this is the top part of the initial support region. We've got kind of few support here, but by and large, this would be roughly a kind of a strong support region one would expect. Okay, this trend line, of course, is key because if it breaks here, then basically we could actually be going lower. But anyway, 3004 is basically the first stop, or there's a high probability of markets reaching there, just based on what we're talking about now. It's actually not something that is showing up only on the chart, but it's also something with which fundamentally people like Morgan Stanley, for example, have also been alluding to. You see, quite interestingly, Morgan Stanley has come out to say that, look, valuations are attractive. We think that stock markets are oversold. We think basically stocks can go up, but it's going to be a bear rally. After that, we remain confident that lower prices are still ahead, and the stock markets will probably go closer to 3004. Mind-boggling, because typically Wall Street firms talk from position. They're typically more inclined to say we are buyers, market's going to go up. Very rarely do they come out and start saying things. We remain confident that prices are still headed lower. It's very rare for them to do so. But in this particular case, they are saying. So basically, they're saying we're going to see a short-term rally here. And true enough, these comments which I post here, these were posted like 2 weeks ago. And we've seen since then what we call a stock market. But at the same time, they are saying this is a bear trap. Bear trap. And in fact, the primary trend is low. That's what they're saying. Okay. And you see Canaccord here, same thing. We think that there's going to be a counter rally, i.e. a counter trend. Okay. But use this counter trend to reduce your exposure. Because why? Because the primary trend remains intact. And because they see further downside potentially up to 15%. Already the S&P 500 has dropped 15. For it to drop another 15 is 30%. So that will bring us actually to somewhere around what I mentioned, 3,400. BTIG, same thing. They're saying we see a bounce, but guess what? It's unfinished business. It's 3,400, 3,500. So by and large, even Wall Street, and these guys are probably a slight mix of TA, technical analysis, but a lot more on fundamentals. So fundamentally, they also see basically about 3,400 on the S&P 500 going ahead. So that's really a little bit of technicals plus fundamentals. Whenever I try and predict where markets are going, it's not just technicals. It's really a game of odds, meaning to say that I bring in the technicals, I bring in the fundamentals, I bring in some of my experience, I bring in the feel of the market, what's sentiment, I add them together and I say, what's it telling me? If 2 out of 3 indicators from this group of indicators tell me that it's going down, then there's a higher chance it's going. If all 3 of them are pointing south, then it's basically much higher probability. But it's only 1 out of 2, then there's a slight probability, not that high. So this is really a question of if all the stars are aligned, then the higher the probability. Okay, so let's move on. So the big question now is just moving back to that first few slides where I said kind of like wow, market's really gone a lot higher. One of the key charts which have really intrigued myself and many economists and strategists out there over the past couple of years is this. Same thing, take it from Fred. take it from Fred. Okay. This is basically something which shows you quantitative easing. It's the asset side of the balance sheet of the Federal Reserve. I won't go into why that's the case, but it's basically Federal Reserve actually buys bonds off the market, injects liquidity. Those bonds now sit on the asset side. So the asset side represents quantitative easing in very simple terms. Okay, look where I'm pointing my cursor now. This was prior to the crisis of 2007. Prior to the crisis of 2007, you could argue that basically the Federal Reserve had about $1 trillion worth of liquidity in the system. Then it undertook quantitative easing 1, quantitative easing 2, quantitative easing, and then there was Operation Twist, all those things that pumped in liquidity. Just before COVID hit, okay, the Federal Reserve basically had about, let's say, 4 trillion, roughly just slightly more than that. So it effectively quadrupled liquidity from 1 trillion to 4 trillion right before COVID. And that was basically to try and combat what we call the effect of the crisis, the potential for deflation, even depression and such. Look how they reacted because of COVID. It went from here to here. This is about 9 trillion. So effectively, the Federal Reserve, in a very short period of time, because COVID was only 2020, in a very short period of time, pumped in about 5 trillion worth of liquidity compared to the previous roughly 10 years where it pumped in 3 trillion. So you can imagine the economy receiving $5 trillion in such a short period of time. Where did the money go? We all know. Money, of course, made its way into assets, whether it's stocks, bonds, crypto and such. I'm just going to show you this chart. This represents not only the Federal Reserve, but the ECB, BOJ, because all these guys were printing over the past 10 years. But it's put together with the S&P 500. So the blue line basically represents the amount of liquidity. The red line represents the S&P. As you can see, there's a very high correlation. So effectively, quantitative easing, printing of money makes its way into risky assets, including stocks. High correlation. So it just really isn't. You don't have to be have an IQ of 200 to say that when money made its way into the markets, into the economy, the markets went up. So the big question now is, since the Federal Reserve has just announced it's removing this money from the system to the tune of about 100 billion a month, maybe about 1 trillion a year. Because why? Because as we all know, too much money is inflationary, so they're reducing it. So this amount here is going to come down. Okay, and so therefore, that's why, as an economist, as a strategist, when you look at this, it's not hard to understand that potentially markets are going to come down. Because if you're going to withdraw liquidity that has been pushing markets up over the past 10 years, then obviously there's going to be a consequence to those assets which actually had gain from that liquidity. So we're seeing risky assets like crypto, we're seeing the stock market beginning to unravel, even the bond market has been hit, and sooner or later I think we're seeing now cracks in the real estate market itself. Okay. One thing also interesting is sometimes we go back and we look at what happened previously as strategists to try and give us an idea of and try and anticipate what's going to happen in the future. So the two crises prior to this was 2000 and 2008, and they were markedly different crises. The 2000 crisis was an external type of crisis, and when I say external, what I mean, it started off as the dot-com bubble bursting. And then there were so-called corporate scandals like Enron, WorldCom, and so on and so forth, Arthur Andersen and such. And we had the September 11 attacks. And then we had SARS. And then we had the Iraqi war. So really, markets didn't have a chance to recover because every time they tried to recover, something came up. Tried to recover, something came up, and so on and so forth. And all these things were basically things which were external in nature, SARS, Iraqi war and such. Whereas if you look at the 2008 crisis, it was basically an internal crisis, so to say, because it emanated from the banking sector in the US. everybody was holding on to subprimes and so on and so forth. And really, it was like Lehman Brothers failing, Fannie, Freddie failing, and then Merrill Lynch had to be acquired, AIA had to be bailed out, and so on and so forth. So there was more internal, and then it worked its way out. Okay, so the big question now is between the two, which one would I, as a strategist, when I look at the current situation, think that the current situation may mirror? And the answer to it is, I think it will be the 2000 crisis, or at least looks a little bit more like the 2000 crisis. So if I line up the 2000 crisis, which is the dot-com crisis, together with the present lineup, I get this kind of chart. Lining up means to put them together. Okay. The first thing that catches your eye is basically, the two charts, if I line it up based on the so-called peaks, the two charts look really almost the same, identical in that run up to the peak. What we're seeing is kind of like a move up the runway, then the takeoff, and then the so-called acceleration or ascent. Move up the runway, take off, and then ascend. And similarly, in between, we've got this short bump here, which was the COVID in the present run-up. And in 1999 or 1998, there was the Asian crisis, Russian crisis, and so on. But it looks really eerily almost the same. Okay. So if I were to just take this, again, this is not what we call a forecast, but this is just to give us an idea of potentially, if it repeated itself, what could happen. So what I do is basically the previous crisis, the dot-com run-up, actually retreated 50%. Okay, bear that in mind. If I take that pattern, as you can see, I've drawn this dotted line here, and I bring this pattern down, what you basically see is this is if we suffer the dot-com situation again, we could be seeing something like this. And it just happens that this 50% also coincides with a fairly strong support, which I did show you previously, slightly below 3,000. If we think of what those analysts, Merrill Lynch, Concord, and stuff like that, they were talking about 3,004. That's within this 30%. Okay, and really, historically, when we've seen slower growth and a recession, it typically falls within about a 30-odd% decline. It's when we see a crisis and stagflation is where we see a 50% decline. Okay, so what it basically tells us is right now, markets falling to this level, where it's factoring in slower growth and potentially a recession, looks pretty decent from the perspective of, hey, we've gone up so much. Come on, we've from 2009 to here. What's a 30% decline? And I think that's where a lot of analysts on Wall Street are saying, what's a 30% decline? It's just a normal historical decline. So the big question now is, are we going to have a black swan? Are we going to see a deeper recession, a stagflation and such? Then we need to be prepared for something like this, which at this point, no one's really extremely worried about it, but we start hearing of chatter of stagflation, the word stagflation, and so on and so forth. Okay, so that's something on the back of even my mind. But right now, I think visibility tells me potentially 3,004, 3,000 looks to be a target which could be hit, basically. Let's move away from stocks. I just wanted to show you another favorite chart of mine, and this is gold. And the reason why this is a favorite chart of mine is you seldom find charts. Okay, when we are, for economists and strategists, we typically like to find charts which correlate so that we can have more or less kind of like a model to help us predict things. Okay, so if you look at this chart, and if I draw just something like this, and it looks like the red line, because when this goes up, this comes down. When this comes down, this goes up. As you can see, it's a mirror image. Okay, what are these two lines? It's again taken from Fred. Fred unfortunately doesn't provide us spot gold prices, so I've taken a proxy for spot gold prices using this particular one, and I've seen the pattern. It looks more or less like gold prices. I've also taken something called the 10-year tip, which is the 10-year yield or 10-year treasury adjusted for inflation, and this really is what we call real. Let me try and write this: real interest rates. Okay, real interest rates is basically nominal interest rates adjusted for inflation. Okay, sorry if the words are not very clear. Okay, so what it tells you is gold prices historically has had this negative correlation which looks mind-boggling, almost one-to-one with real interest rates. When real interest rates go down, gold prices go up. When real interest rates start to move up, then gold prices start to move down. Okay, so here when real interest rates go up, for example here, gold prices come down. Okay, so recently in the year 2019 onwards, we saw basically real interest rates collapse, gold prices go up. Okay, so almost like textbook to the dot, following whatever historically we've seen. Okay, sometimes charts don't continue with what they have done historically, and that becomes also super intriguing for people like me. So when I see something like this, which was truly expected, because why? Because the Federal Reserve came in and said, we're going to hike 50 basis point, 50 basis point, 50 basis point, 50 basis point, whatever the case is, it was very clear that real interest rates would actually spike up because nominal rates would increase and it would exceed inflation eventually, and real interest rates would go up. But we did not see gold prices collapse, which historically would be the case. So something like this, in my shoes, I would be like, what's happening here? Is it because the market here is anticipating basically a recession, a stagflationary situation where the Federal Reserve and many central banks, their hands actually will be tied. They can't raise rates because growth are slowing, and therefore whatever the market has priced in cannot happen as the market has priced in. So if this is the case, there is going to be a rollback of expectation in terms of tightening, and that would actually result in this coming off. This was a false kind of rally, and when this comes off, this will go up. So you can see quite interesting. Sometimes when we look at these things, we try and interpret it. Why is it that it's not following? What's behind it? Could this be a trading opportunity? Is market pricing in the wrong thing? And so on and so forth. Okay, so I hope it's a bit technical, but I hope you understand where I'm coming from on this. Okay, and I'm going to just round it up with one or two slides or three slides on cryptos and just focusing on Bitcoin, because I know it's something on everybody's mind. This is not a chart which I came up with. If you've been following Plan B, and Plan B is this guy who came up with the stock-to-flow model. He has two models. He has the basic stock-to-flow model, and he has something called the S2FX model, the second stock-to-flow model that he had. And this is actually a much more, in my view, stronger model compared to the first one, which I think has been invalidated to a certain extent. Okay, this model itself tells us basically, for commodities that are limited in supply, you can actually mark out what we call the stock to flow. Okay, and this is for commodities and commodities like silver, diamonds, real estate. These are things where you can actually measure supply, growth rates quite easily on a yearly basis, and so on. Okay, so what does it tell you? When he calculated a stock to flow, for example, of certain assets like silver, diamond, real estate, gold, and such, it corresponded to a certain market value or market cap. Okay, so for example, and I'll show you first. Okay, first and foremost, Bitcoin today at 29,000 roughly has a market cap of about $500 million. Okay, silver has a market cap of about 1.3 trillion and has a stock and flow roughly around this level. Okay, gold with a 12 trillion kind of market cap has a stock and flow about here. Okay, so it kind of tells you there's this correlation between stock and flow and market cap. Okay, so what it really tries to project is Bitcoin today, while it's say somewhere around here, okay, as it moves up in terms of market cap, okay, it will eventually overtake silver. It did momentarily before falling back. It will eventually overtake diamonds, and it will eventually potentially go to gold. So you have to have that assumption. So if you ask someone like me, hey Sani, where do you think Bitcoin is going in the future. I would confidently say I think it's going to overtake gold in terms of its market cap in the future. So Bitcoin today at 0.5 billion market cap, I think it's going to go to 12 trillion. I don't know when, but I know in the future it's headed that direction. So the interesting part about this market cap thing is market cap. Okay. Market capitalization, sorry if you can't see that, is actually equal to price times supply. It's like your stock market. Maybank is basically Maybank's share price times Maybank's circulating issuance of shares. You times that two, you get what we call market cap. So in this instance, okay, if I were to assume that Bitcoin, okay, has a market cap of 12 trillion, can I then derive what the price of Bitcoin is, given that I know what the supply of Bitcoin is? So you see how so if I'm going to write that equation, it would actually be 12 trillion equals to price of Bitcoin times 21 million. So if I want to solve this equation, at 12 trillion market cap, it will be 12 trillion divided by 21 million. That will give me the price of Bitcoin if it went to a market cap of 12 trillion. Okay, so that is the intriguing part. Because if you've taken out your calculator and if you've done this now, as I was talking just now, you would arrive at this number. It's Bitcoin of about 570,000. Okay, so if eventually Bitcoin did go beyond so-called gold's market cap of 12 trillion, given that we know the supply of Bitcoin is 21 million, then the equating price of Bitcoin has to be $570,000 per Bitcoin. Okay, so this is, again, this is not a prediction. This is just saying the assumption is if it goes there. Okay, so I thought this was very interesting, and I felt like, oh, okay, wow. I think because my original assumption was I think it's going to eclipse gold, but this gave me a number to attach to it if it does so. Okay, moving on very quickly. Lynn Alden, highly recommend you follow her in Twitter and YouTube. A macro person. She recently came out to say that she looks, because she's a macro person. Okay, she's not a pure crypto. She's like a macro economist like myself. So she said that PMI, which tracks the business cycle, and Bitcoin, there's a correlation. So it's quite intriguing. This guy came out because I think he saw the same YouTube as I did. Came out and he actually came out with so-called a chart of Bitcoin and a chart of the PMI. Okay. So what I did was I added color to it because this was quite plain. So I added color to it. So if you look here, basically the PMI is a cyclical kind of thing. It's like a business cycle. So let me just try and draw it nicely here. So this is the PMI. Up, down, up, down, up. So this is very much like a business cycle. When the business cycle is down, Bitcoin actually goes into a range. When the business cycle is down, it goes into a range. When the business cycle is down, it goes to a range. Currently, when a down cycle is in a range. When it's up, then of course it's in a rally and so on and so forth. Okay. What's interesting to note is when it's in a down cycle, Bitcoin doesn't bottom at the end of that cycle. Bitcoin actually bottoms in the middle, roughly in the middle of the cycle, in the middle of that down cycle. And that's B here corresponding to A here. Okay. So if you were to take this, and again, this is again just one of the many indicators that you can just take, you would say that basically we are almost approaching that middle cycle, and therefore one could argue that we would probably be approaching a Bitcoin bottom pretty soon. Okay, so it doesn't tell us where that bottom is. It just tells us roughly historically when the economic cycle is midway through a downturn, Bitcoin tends to bottom out. Okay? So having seen that, what I did was basically I tried to play around with it. I personally look at something called the OECD Leading Economy Indicator, which is also looking at business cycles, but it's looking at business cycles more on a so-called leading indicators. It tries to predict the business cycle going forward. And I did a kind of like a moving average of the leading indicator and so on, playing around with it and using it a bit like a buy and sell signaling, okay, and kind of got something like this. So I did a fast and slow moving indicator for this OECD indicator, and this is what I got. Okay, so whenever there's a crossover, and these are the numbers here representing Bitcoin prices. Okay, again, these are just numbers. I don't think we ought to say that this is a model to buy or whatever the case, but it just tells you roughly that the model itself has some predictive power. Okay, having stopped here, okay, I had to make some prediction, and I had to then use basically the O down cycle to basically superimpose it here, because this model doesn't tell you what's in the future. So I just used it and put it there. It gave me kind of like a bottom in Bitcoin roughly around here, which again tallies in line with we're in the middle of it tends to bottom in the middle of the PMI. That gives us a couple of months into the future, and we are already in May, going to June, July, August. So I won't be surprised that somewhere in between June and November we could actually see a bottom in Bitcoin. So it just gives us an indication. And like I mentioned earlier on, and before I end, is that these models, basically, you don't take them in isolation and look at them and say, this is the model. You take a few things and you ask yourself, if everything is pointing in one direction, if everything is telling you that it's likely to be the case, then that probability increases. Does it increase to 100%? Never. It just tells you that there's a high probability that the thing is going to go this way. Okay. All right. So I think I'm done.
Mr. Sani, so here are the questions for you. Let me just scroll up. There are actually a lot of questions for you. So even though you're done with your presentation, I'm sorry, we still can't let you go.
No worries.
So the first question here is from Ragnar. I'll just highlight the question and then you can just read it and then you just...
sorry, I need to go to where to see your screen.
You head on over to the public lounge over there and you click on live. You click on my name, you'll be able to watch my stream.
Oh yeah, watch screen. Yes, I saw that already. Okay, thank you.
Yeah.
Old people like me, very difficult.
Don't worry, it's fine. So I hope you can see the first question.
Yeah. What are your thoughts on Fed reducing their balance sheet? Will it affect the market? Yeah. Will we see a rotation of capital flow from bonds to risky assets like stocks and cryptos for relief rally before? Well, I think I've kind of answered that to the dot, in the sense that the charts which I showed you actually showed that with a reduction in the balance sheet, risky assets, as liquidity is pulled out, risky assets are most likely going to fall, and they have fallen basically so far. So that's the first question. Bonds is there going to be a relief rally? We are seeing that relief rally. People on Wall Street are expecting that relief rally, because why? We've seen weeks and weeks of, at least a couple of weeks of decline. Declines do not go down in a straight line. Any bear market always have relief rallies, bear traps and such. Many Wall Street analysts see the current rebound as a so-called bear trap. And I think I put evidence there of who's saying what. Okay?
All right, thank you, Mr. Sani. We hop on over to the next question. Is this one over here.
Okay. Yeah. Do you know that actually bonds have had one of their worst sessions over the past multiple decades? I've even seen one article saying that this is the worst bond market in at least half a century or more. Bonds if you go and call up some bond performance indicators, and all you need to do is go to some unit trust that invest in bonds. Asian high yield bonds are down like 30-40%, and just thanks to China. But other bond markets are down by at least 10. Even the safer bonds are down by high single digits. When a bond market falls, or when a bond falls by at least 9, 10, 11, 15%, that's a huge thing. Because why? Because bonds are low yielding assets. They yield 3-4% at most, coupons maybe 1-2% at most. So when you say a bond falls by 10%, it's wiping out 5 years of coupons. So that's why the bond market, compared to the stock market, did extremely badly compared to the stock market in at least the first 4 months. And that is why some people now, including ourselves, are saying, hey, there could be, and Citibank is one of them, there could be an opportunity in the bond market because it's just fallen so much more compared to the stock market. And if a recession is coming, Federal Reserve and many central banks can't raise rates, and they're going to roll back on that aggressiveness, it's going to benefit the bonds. So between equities and bonds, if you were to ask me which one has slightly better opportunity of being nearer to their bottom, then basically it's the bond market.
Right. Thank you for your answer, Mr. Sani. Over to the next question right here.
With quantitative tightening on cost, do you see the S&P Nasdaq retracing back to 08 levels? It will be absolutely decimate the. Yeah. I do see it moving back to pre-COVID levels, and the pre-COVID levels is at 3,004, maybe 3,000 level. You're right. I doubt the Federal Reserve will allow it to go all the way back to 08 levels, which is like super far from where we are today, because it really would have a very bad impact. But one mistake I think investors are making today at this current juncture is everybody's assuming the Federal Reserve will support the market at this point. Let me remind you that all central banks in the world have two mandates, typically speaking. Mandate number one is price stability. Mandate number two is full employment. The stock market has never been a mandate for many central banks. The only reason the Federal Reserve has supported the stock markets over the past 10 years, and you may argue, hey, but past 10 years, didn't the Federal Reserve come and create so-called Fed put, preventing the stock market from falling? True. The only reason they did that was for the past 10 years, the worry was not inflation, the worry was deflation. After the crisis, people were worried about deflation and Japan type of deflation. So the Federal Reserve, in order to combat deflation, started to use what we call the asset market as what we call to create wealth. So the wealth effect was the best thing to counter deflation. But it did not mean that that was the main objective. It's just that the situation then compelled them to use that strategy because it was a deflationary environment. Now that inflation has come back to the forefront, their main target is still inflation. So you will find that there are a few Fed officials who actually have come out to say that monetary tightening that the Federal Reserve is doing, the stock market will be a consequence or will be suffering because of that. They have come out straight in the face to say this is collateral damage. If we need to, we will raise rates. But my feeling is they will allow that collateral damage unto the point where, like the person who asked this question, maybe about 3,000, somewhere around there. And when it starts to basically go below the pre-COVID level, I think that's where they will start to jawbone the market higher. So to a certain extent, they will allow market to fall. But there will be a point where they'll come in, but we haven't reached that point yet.
Right. Thank you, Mr. Sani. I think that is all for the questions right now, apart from all the compliments for you lah. They're all saying
thank you very much, everybody.
Yeah, the attendance here is amazing. Thank you guys all for coming. I do have one last question for you. Is that looking at this chart right here, comparing in my earlier session I compared the dollar index, tech index, and Bitcoin. Right? Is Bitcoin currently decoupling from the tech sector in the US, or are we going forward to see a relief rally for Bitcoin, and then after that following how the tech moves again?
Yeah, it's very interesting. I was following this, and it's kind of mind-boggling why it moved. I have my theory behind it, and someone asked the question on Twitter, and I kind of gave my theory. I may be wrong, but I gave my theory, and my theory was this: the stock market is where settlement is very fast. T+1, T+1, T+2, T+3, maybe T+5 kind of thing. So what I mean is, if you want to sell, you'll be able to sell very fast. Okay, there's no pent-up selling pressure in the stock market because everybody who wants to sell can go and sell in the market. But if you look at the crypto market, apart from the retail who can go to your Coinbase and whatever, tokenize or Synergy, whatever you want to sell, you can sell. But the hedge funds who are in the market, the institutions who are in the market, for example, we deal with a particular digital asset fund. It's a hedge fund. The settlement or pricing is monthly. You want to sell means you put in your order now, but your order won't get filled. Your order will get filled basically month end or the next pricing date, which is 1 month from now. Which says that because of that huge LUNO situation, there's bad sentiment on the markets. People who wanted to come out from hedge funds have put their order in, but guess what? The selling probably is pent up because there's a 1 month period where the fund manager will start raising liquidity by slowly selling. What I'm trying to say is the timing does suggest that we may be seeing what we call, because the settlement period for liquidating crypto hedge fund sell orders is weeks. There may be what we call a queue of selling orders there, which have yet to be executed, and that's breaking that correlation between the Nasdaq and the crypto market. I hope it's not too technical, but that's how I feel. That's how I would explain this at this point, because otherwise there's very few reasons why the correlation would break in my view lah.
Yeah, so in essence, we are going back to the correlation with the tech index in the near future, probably within the next few weeks.
So you're right. Yeah. So temporarily,
we'll see a relief rally.
The sell orders may result in this, but at the end of the day, also, who knows? In 3 weeks' time, the tech, like I say, if this is a relief rally, the tech may go down, and just in time, the crypto is also, there's still sell orders there. So.
Yeah.
By the time the crypto catches up, it may be a downtrend already.
Exactly. So we are still expecting the tech index to be highly correlated. Sorry, Bitcoin to be highly correlated with the tech sector. Just that right now it's a temporary off tangent, temporary decoupling. But after that, sooner or later, you will couple again soon. Yeah. We are expecting that.
Correct. Because I think increasingly, one of the things I also wrote on my Twitter feed recently was that basically, when you look at it, basically what are cryptocurrencies? The majority of cryptocurrencies are basically very much like VC or greenfield, brownfield tech projects. That means very early stage tech projects. Who comes and invests typically in these kind of tech projects? Traditionally venture capitalists, traditionally angel investors. Now we have, for the first time, the opportunity for people like you and me, for example, to invest in the same shoes of a venture capitalist or an angel investor. But it's the same thing, early stage, yet to be tested truly, projects, which hasn't sometimes not even made money yet, and so on. So high risk, high return. So the thing that is the thing with where we are today. When you withdraw liquidity from the system, when the market is in an off-risk situation, the riskiest of the assets will get walloped first. And that's what we're seeing. I think it's just common sense that, when markets are afraid, between bonds and the whole spectrum of the stock market, you'll find that high quality stocks, defensive stocks like utility, healthcare, they hold steady or they don't lose as much. Then you find small caps losing a lot. And if you go out from the stock market and go into the private equity space where you're talking about venture cap and so on and so forth, these are the guys who will get walloped when you withdraw liquidity. And I think that's what we're seeing for the crypto side, because the cryptocurrencies are a representation of these type of early stage where VCs and angel investors come in.
Mm-hmm. Yeah, I think you made a lot of
sense. The riskiest of the risky assets.
Yeah. Generally, investors have been really risking off at this moment of time, and we don't expect them to continue to risk on now. We expect them to continue to risk off because from what you said just now, there's quantitative tightening, so on and so forth. But yeah, I think
but at the same time, it's again when we hear some of the fund managers talking, and these are credible fund managers, they are starting to nibble already, because they see signs of the market being sold off so much and so on. But they understand, and because their time horizon is very long, so 3 years, 5 years. So guys who come in and buy now, I think I just saw an interview, Polygon Capital. They said I'm buying now. Even if it goes down by 20-30% from here, 50%, I'm fine because I know I'm buying low compared to 3 years or 5 years from now. Retail investors don't typically think like that. Retail investors, you buy now, goes down 30%, you start selling because you're afraid you're going to lose everything. Yeah.
The paper hand mentality, Yeah. But I think that's all for the questions tonight, and it has been a really wonderful session. It's really good to have you here. I think people love you, and I think that whenever you're free, if you want to do a session like this, probably take over the entire session, you're more than welcome, because sometimes I do want myself a good break also. If I were to just, let you do a bit of my work, but anyway, we would love to have you here again next time, and I think the audience here also is feeling the same way. Again, thank you so much, guys, for joining us. And let's just give a round of applause. I mean, virtual round of applause for Mr. Sani. And drop your thank yous over at the Crypto General chat. Make sure you just say thank you to Mr. Sani. He gave everything of this for free. And it's amazing how much detail is within his presentation, and looking forward for more of this stuff. All right, Mr. Sani. All right, everyone. Good night.
All right, thank you.
I'll
Stay
see you
safe.
guys.
Bye-bye.
Bye-bye.